Well, with the war in Iran, consumer sentiment has fallen to an all-time low. The final read from the University of Michigan showed consumer sentiment dropping to 49.8, lower than that even of the pandemic. Joining us from Warsh, Joe Brusuelas, RSM chief economist. Now, Joe, it's good to see you. The read wasn't quite as low as the initial read, but nonetheless, it did remain at a record low. And, you know, it's an interesting point that my producer brought up, that it is lower than this record. It's lower than it was during the pandemic. It's lower than it was during the financial crisis. Like, that seems a little surprising, right?
No, it is. You would think that we're nowhere near the crisis we were at the depths of the pandemic, yet the very sour mood of the American public is on vivid display here across that data. You know, as an economist, I tend to open the data feed and take a look under the hood. When you do that, what you're finding is that conditions are coalescing. If the war continues into May and June and July and August, we're creating the conditions for some demand destruction. Let me throw some statistics out at you from that Michigan survey. 66% of the survey participants said it's a bad time to buy a major household appliance. 75% say it's a bad time to buy an auto, and 78% say it's a bad time to buy a house. Now, we've had a pretty big supply shock. Gasoline prices have jumped significantly. You know, I think about 8 out of 10 Americans at this point are beginning to pull back on their demand for gasoline. You know, consumer sentiment, as we would expect in terms of the 7 channels of demand destruction, has turned real sour. The next pivot point, which typically comes in months 3 to 6 following the supply shock, is you get a turn downward in demand for durable goods. So when I see data like that, I do take that seriously under these very unusual conditions we find ourselves in, especially with oil pricing in real risk, but our equity markets pricing in effectively an end of the war. Only one of them can be right, people. And right now it's really uncertain which one's going to be right.
Well, I've had other economists come on here, Joe, and say the U.S. economy is doing pretty well. Earnings are looking pretty good. And, you know, maybe the expectation is that these sentiment numbers will not translate into spending numbers.
Okay, so the American economy, it's a $30 trillion dynamic and resilient beast. It's absorbing the shock, and much like we expected. Now, the shock's large enough, though, that my very sunny 2.4% rate of growth for this year had to be downgraded to 1.7. So we want to be careful that we don't do red light, green light, 0-1. The economy is slowed compared to where it was, but it's not going to go into recession, at least right now. But we always have to make sure we need to differentiate between, hey, we've got some very strong earnings, especially around tech and some parts of the banking system, that said the first 2 months of the year were actually pretty good. In many ways, it's an echo of what might have been. And we'll see that next week when we get the GDP. And I would expect to be a not so friendly set of Federal Reserve discussions coming up.
Yeah, the Federal Reserve discussions that are coming up, and apologies, Joe, because I am seeing some potential headlines here about what's happening with the government probe into Jay Powell. So we're gonna look into those and circle back to that. Right now, what are you expecting in terms of interest rates for the remainder of the year?
Okay, so right now, if I take a look at the rate sector, we should be sitting right around 4.25%. But given the supply shock and what we know is a real crisis in Asia, and one that if we don't solve this soon is going to happen in Europe, one would think that investors would push rates higher. So we have we're in a period of elevated uncertainty. And I really don't envy those at the central bank who are going to have to make decisions in the second half of the year if the war is not wound down before then. I think for now, though, again, the oil market's priced in real risk. But equity markets, fixed income and currency markets, not so much.
So, Joe, I was looking into this report here, and it does look like that Jeanine Pirro, is saying that I believe it looks like I'm seeing reports here that they're dropping this investigation of Federal Reserve Chair Jerome Powell. And as we know, that had been the thing that was holding up the Kevin Warsh confirmation. Tom Tillis had said and reiterated during Warsh's confirmation hearings that he would not approve his nomination until this was closed. So if this is indeed the case that it's being closed, how quickly then could that confirmation move forward, and how quickly could we see Kevin Warsh taking the chairmanship?
Okay, couple things. First, Jerome Powell stood tall. He stared down the president. The DOJ blinked. That investigation appears to be going away, which paves the way for Kevin Warsh to become the next Federal Reserve Chairman. One would think the U.S. Senate will want to schedule that vote as soon as possible because they would like Mr. Warsh to take hold of that June meeting. Now, that does not mean that the controversy over whether Mr. Warsh's independence will go away. My sense is if that Kevin Warsh comes in and let's say at the first meeting where he's in charge, he wants to cut rates, he's actually going to be expressing a dissent along with Stephen Mirren, that he'll be outvoted by the members on the committee, which is something the market is going to have to adjust to. But it's very interesting. This is happening all live, very well for that. So I would expect Mr. Warsh to be confirmed quite quickly.
And I am now seeing this tweet by U.S. Attorney Pirro here, saying this morning the Inspector General for the Federal Reserve has been asked to scrutinize the building cut, and then I've directed my office to close our investigation. But it looks like the Inspector General is still looking into this situation, but it looks like she is dropping her investigation. So I don't know if the Inspector General still doing the investigation, if that has any implications for Pirro, for Tillis. I guess we'll have to see. I'm also curious, so you talked about the dissents that will happen, and there has been some speculation about whether Kevin Warsh will be able to sort of get consensus on the Fed eventually, if not in the beginning, as you point out. What will his leadership be like over time? What should we be watching on that front?
So when you think about Kevin Warsh, his first instinct is quite hawkish. But we know, based on his voting record going back now close to 20 years, that he's very hawkish when there's a Republican in the White House. When there's a Democrat in the White House, and he tends to be very dovish when there's a Republican in the White House. So there's real reasons to challenge his bona fides on how he would operate the Federal Reserve. Now, I'm in explicit agreement with him on the dot plot's got to go. I think that the scandals, the insider trading things that go on, that has to come to an end. And it makes sense to me that there's going to be a bit of reform around how the Fed manages its communications policy. But when it comes to setting interest rates and the balance sheet policy, he's going to get a big pushback from the members of the Fed, not just the presidents around the country or the Board of Governors, but the staff itself. Mr. Warsh is going to have to reestablish his own credibility. I was one of those young economists, and I read every word that he published on the economy, especially during the great financial crisis. And I got to tell you, I still haven't quite gotten over his need to raise interest rates into a deflationary abyss that the U.S. economy almost fell into. That would have been one of the more epic policy errors ever in the history of central banking. So I've got some real reservations about him. He reminds me, because he is a product of the Washington think tank community. He's memorized his lines. He says exactly what he thinks you want to hear if you were a Washington think tanker from the 1990s. But when we get these sorts of shocks, like the one we're in now, Mr. Warsh often comes across as somewhat lost. He's a follower, not a leader. So what I'm going to be looking at when he does take charge is when we have these periodic financial hiccups, these crises. Who he leans on, my guess, is John Williams at the New York Fed, Christopher Waller. He's got good people around him. So I am confident the Federal Reserve will continue to do the right thing. But Mr. Warsh will have to be convinced, because I do remember a time when him and Ben Bernanke, perhaps they had a very different view on economic and financial firefighting. And I think history shows Mr. Bernanke was absolutely correct.
I think safe to say, yes, that is the case. Joe, finally, we've got a Fed meeting next week. Obviously, Jay Powell's going to get some questions about this. Do you think he is still going? I mean, it was widely expected he would be staying on, right? At least for some period of time, because he still viewed the independence of the Fed as under threat. Do you think if this investigation is concluded, that will still be the case?
No, I think that he will actually conclude his term in May, and he will then step aside. But we'll have to see how these things play out. Based off of what you told me, it looks like this has indeed been dropped, and they're going to create a political fudge just to get it to disappear and go away. So my sense is we'll have a new Warsh-led Fed, and we'll have to adjust to that.
There's no better read right now on consumers having to spend $4 a gallon gas and make tough budget decisions as a result than Tide maker P&G. I sat down with P&G CFO Andre Schulten moments after earnings were released earlier today.
The P&G team delivered a great quarter, very solid progress, and exactly what we wanted to see, which is really building momentum sequentially. And it gives me great confidence. Three things that drive the confidence really. Number one, 3.4% organic sales growth is a very solid result ahead of markets. It is broad-based. All 7 regions are growing. All 10 categories are growing. So it's very broad-based and robust growth. Number two, shares are stabilizing and growing now in the past 1 month at a global level. And in the US, we have solid volume share growth. So importantly, we see consumption growing ahead of market. The third component, we are able to deliver that top line growth with roughly EPS growth in line, 3% core EPS growth this quarter. And that is with the significant investment we're making to strengthen our brands, strengthen innovation, strengthen performance and value, led by great productivity. So I have confidence that with that, we can continue to make those investments and sustain the momentum. And that's really what's driving the results, the continued intervention on all of our category country combinations to get even sharper on what we define as superiority, product performance, package, go-to-market execution, communication, relative to the price we're charging the consumer. Once we get that right, Brian, then things start moving. Great example is Tide Liquid. I think we talked about this in our last conversation. We put the biggest formula upgrade on Tide Liquid in the US in September of last year. And now that part of the business is growing mid-teens, and it's a big business. So when we get this right, which we will, things start happening, and that's what's building the momentum.
Coming into this year, Andre, the economy was doing pretty well. January started, it was good, and then like pow, end of February, we now have a conflict with Iran. What did you see in the business in terms of organic revenue in March?
So the impact on the organic sales line is relatively minor. The Middle East in and of itself is only 2% of our global revenue. And our team in the Middle East, I have to thank them. They have shown amazing resilience and amazing discipline to work through this. So we continue to see momentum. We actually saw acceleration in the month of March. So the top line impact right now is not really visible. The impact is in the cost line, Brian. We are expecting about 150 million after tax hurt in Q4 from just the impact of higher fuel prices on transportation, which is flowing through the P&L more quickly. But then we expect next year, the full year impact, including the commodity cost increases, supply chain costs, to be much more significant. And that will be the majority of the impact from that conflict.
Mm-hmm. Within the U.S. consumer, what have you seen from them? Not so much are they trading over to private labels. I won't go there necessarily, but are they trading down, given costs of their life have gone up, energy prices, gas prices, are they trading down to smaller package sizes as a result of this?
I would describe the situation right now as stable. Consumption in our categories is still a bit muted versus what it used to be. So the category is growing around 2 to 3% versus the historic level of 3 to 4% across our portfolio of categories. But the consumer is relatively stable. We see the bifurcation that we've been mentioning before. So you have some consumers looking for value in larger pack sizes. They shop in club, they shop online and in big box retailers. And then you have some level of consumers that are looking for value in smaller pack sizes. They're looking for a small smaller cash outlays in promotions. That dynamic continues. On the positive side, like I mentioned on the Tide examples, consumers in the US and globally are still very receptive to innovation, to product performance upgrades. So when we show the right benefit at the right level and at the right price, consumers are coming in and consumers are actually trading up within the P&G portfolio. So that continues to be a core strategy for us to ignite market growth, delight the consumer, and build our brands. But the overall environment right now, Brian, I would characterize as stable. We're watching this closely, as you say, a lot of things happening on the consumer side. We might have been helped a little bit by tax rebates coming in, but we're watching it closely, and I don't think that the gas price increases, et cetera, have yet shown in the consumption or in the numbers in the quarter.
Do you expect them to show up?
We'll watch it. Hard to predict. Again, our categories are daily use categories. They are not really that discretionary. Consumers want their laundry to be clean. They want their diaper to work, and they use them on a daily basis. So we are less exposed than maybe some other categories. So we're watching it.
Within the cost headwind that you outline, I mean, there's a couple buckets. It's the higher cost for what's in, let's say, a Tide. There's the packaging. There's the energy that helps move your manufacturing sites. Like, what has this backdrop done to the cost of making these things?
Yeah, as you say, it goes across basically every part of the cost of goods line. Oil, diesel, transportation is a significant impact. That is the impact that is hitting us in Q4. But then a lot of our inputs are petrol-based. So higher oil price means higher input cost for our suppliers. And then there's a capacity component. Some of the manufacturing facilities have been damaged in the war. And even if they haven't been damaged, some had to shut down because they didn't get some of the input materials. Look, we know how to deal with this. We've done it before. P&G is well positioned in this. We have an amazingly capable product supply organization. They work across R&D, procurement, and our supply chain teams. We know how to reformulate if we need to because we can't get a material. We know how to shift sourcing between multiple suppliers. We have a very diverse supplier base. And we know how to drive productivity in order to offset a good part of that cost headwind. And the last component, how to deal with it, is really innovation. Innovation that allows us to price, but still delight the consumer. That's the playbook we used coming out of the COVID supply chain crisis that served us very well. It will be the same playbook as we go through this. And I think overall I like our odds in that game because I think we have a very strong team and very capable organization to do this.
I would say this is the second straight quarter, Andre, where the beauty business really surprised me to the upside. There seems to be some form of acceleration in this business. Two questions. One, what is actually driving that? And then one of your competitors, I believe, purchased Olaplex. So they're leaning harder into this category. Do you want to bulk up even more in this business, given how fast it's growing?
The beauty business, as you point out, Brian, is doing very well. 7% organic sales growth in the quarter, and really across every part of that portfolio. Personal care growing 7%, skincare growing 7%, and hair care growing 6%, broad growth across regions. What is driving it? Exactly what I was describing. We are getting the superiority equation, the value equation right for the consumer, great innovation, improving product performance, the packaging improvements we're pushing out, the great communication of those benefits across all relevant platforms, and superior execution with our retail partners offers great value at the price that we're charging. Consumers are trading in and trading up. And a great example for that is SK-II is growing, which is our super premium skincare brand, growing 18% in the quarter. So I think consumers are looking for ways to reward themselves, delight themselves. We are giving them that opportunity at a relatively small cost, and they are responding. And I think that's an enormous opportunity we still have and will be driving. So I see a lot of upside for the beauty business.
For what it's worth, I'm one of those consumers. I actually use that SK-II, that water-looking product. It works. I mean, I think it's wiped 10 years off my face.
It shows, Brian, it shows.
Well, thank you, Andre, for doing this. I know it's always busy on earnings day. We appreciate it, and we will talk to you soon.
Man, this is quite a move in Intel. My big question is, and Matt, I'll start with you. Yes, the numbers looked good for Intel. Do they look good enough to justify a new record for the stock?
I struggle with it a little bit, Julie. I certainly think that server demand is better than anyone anticipated, and that's helping Intel out and should continue to help Intel out. They're best positioned to ramp supply at this point, so they should be the major beneficiary of that better demand for compute. At the same time, I think really when you look further out, Intel needs to address some of its core issues, like its problems around foundry and fab, and its problems with chip design. I don't think we have answers there yet.
And Cody, what do you think?
Well, I would take a bit of an issue with that. I think that they're starting to get their legs under them from a turnaround strategy, and their foundry business is starting to show signs of traction, especially with 18A yields coming up nicely, and their production expecting to ramp 6 and 7 times their Q1 numbers into Q2. So I think they're making real strides on the foundry side. Obviously, the CPU that's getting inference demand and agentic AI traction is coming back into to focus, and I think that that's just starting to get legs under it. So we'd like Intel here into the our $105 target.
Where do you think, Cody, if you had to look for where the vulnerabilities are, where do you think they are? But even if you're confident that they're going to overcome those vulnerabilities.
Well, I think that that its parabolic price move here is its biggest risk, and just the street expectations have gotten elevated, and so whenever you get this kind of price move, there's always a risk for air under the stock, but I think fundamentally, Lip-Bu Tan is just really starting to hit his stride from a turnaround maturation. Like I said, they're starting to get their foundry legs under them, and their CPU demand is just really starting to hit the inference stride as well. So I think the stock is its biggest risk, and just with the move higher.
And Matt, are the 18A promise, I guess, the promise of 18A, what are you going to be watching most closely to see how quickly that's coming to fruition and how successful it's going to be?
Yeah, it's the ramp of their current generation of PC processors. So that's what they're making on 18A. If we see their PC business continue to track well in what's a difficult environment, and they've given relatively ambitious expectations on that front. Right, PCs are being impacted right now by high memory costs, but they're looking for that business to remain at least stable into the remainder of the year. If that proves out, if gross margins continue to get better, I mean that's all good news for 18A. That gives you some confidence around what they do with 14A too, and then eventually their prospects to regain some share from AMD.
And guys, it's not just Intel that is seeing this rally, it's the whole semiconductor industry. You look at the SOX, the Philadelphia Semiconductor Index, I mean, the wind strength this thing has been on has been incredible and unprecedented. Cody, what do you think is going on here? What's behind this recent surge, and what do you think happens now?
Well, I think we've just had a return to optimism around the AI trade with everybody that's really related to AI infrastructure, from processors through the connectivity plays from the Astera Labs, Lumentums, and Coherence are all parabolically up here. But I think the optimism around the demand is correct. The demand spending, the capex budgets are real, and the demand from an inference and agentic AI is really just starting to get the enterprise side return on any kind of investment. And so I think all of that is an extendable demand curve, and that should continue to elevate these stocks.
And Matt, something that I keep coming back to when it comes to semiconductors is how much things have changed for what was once a highly cyclical and commoditized industry. Is that, I mean, is it just not anymore? Or is it that the cycle is now so long because of AI that you can't see the end of it?
I think that's exactly right. So you go back to the internet boom, for instance, right? 95, 96, when productivity just started taking off, right? You couldn't see the end of it. And so you see an elongated boom. At some point, you have too much build on the capital side. At some point, we get consolidation. It seems like it's always inevitable in these cycles. Having said that, like Cody said, we're just at the start of inference, right? This is something that showed up middle of last year, so early innings, and it's hard to tell when we'll get to the point that it's played out.
So Cody, when you're looking at this group, if you do see that demand just continuing, like, do you buy everything? Do you just sort of say, okay, most of the companies in this space are going to benefit from this trend?
Well, it is that easy to a certain extent, because anybody that is AI levered, that's servicing a bottleneck need, whether it's compute or memory or connectivity, and there's many ways to lever into the AI trade, to capitalize on these capital equipment budgets that are coming out of the hyperscalers, and so we look for the bottlenecks, and anybody that is participating there, whether that is on copper or it's optical infrastructure, whether it's compute or memory. I think, like you said, you could buy a basket of these and all do very well.
All right, guys, thanks a lot. Cody, Matt, appreciate it.
This Intel quarter, market loves it. Do you love it?
As a premium seller, I didn't love it that much. It got a little outside the range. 3 standard deviation move, a little heavy for me, but it's been a great trading vehicle for the last 2 hours. I mean, it really depends. If you're long Intel, yeah, sure, you love it. But if you're an option trader, a little bit outside the range.
Tom, seeing Intel rally from the depths of hell last year, we were all questioning if they were even going to be in business anymore. I mean, this was not on my big O card coming into this year. I mean, if one has been long Intel, really what has turned into one of the hottest trades this year, do you just stay long because of the momentum?
Well, I think, going back, a lot of us have been, we got stuck long Intel for about what felt like a decade. And I think the stock probably traded between 21 and 28 for what felt like 10 years. And I think for most of us that were choking on Intel for so long, when we finally got a chance to get out of it, we jumped at that opportunity. I think if you've been long Intel since kind of the bailout, I would say you pretty much have to stay in, because if you were going to get out, you probably would have got out at 30, 40, 50, whatever. I mean, there's no way you're holding it till 80. So at this point, you might as well just go and stay in for the ride.
So true. Inez, let me get over to you here. This move in Intel, it's not completely isolated, because we are on a record-breaking streak for the Philadelphia Semiconductor Index, better known as SOX. If you go to the Yahoo Finance homepage right now, really awesome story by our very own Jared Blickery. I believe Intel's stock price has taken out the dot-com high. It's been amazing to see this epic rally.
Yeah, chips have really been the ones that have been leading this market. And what a change of fortune really for Intel. Remember that this was a Dow component at one time. Back in 24, it got replaced by NVIDIA. And if you also look at Intel and how the stock has performed, I did a little chart of how the stock performed after the U.S. announced its investment in Intel. It's up 250% since then. It was at around $23 a share when that happened. So certainly a change of fortune here. But look, this also speaks to the entire space of what's happening in the entire space. And you have that upgrade from AMD, D.A. Davidson on AMD, basically talking about CPUs. Now this is supposed to be the next big bottleneck because of CPUs and the demand because of AI, agentic AI.
Inez, this is one big bubble, one big SOX bubble, Inez.
Well, look, D.A. Davidson thinks that this is going to continue. I mean, they're looking, Gil Luria, excuse me, basically is saying that this is the next big bottleneck, and you are going to see, this is just a precursor for what AMD is going to be announcing when they report on their quarterly results. I would note, it's not just CPUs with Intel, it's also their advanced packaging. Remember, Saz, we talked about this a couple months ago, that some strategists were actually really bullish on this advanced packaging, and something that NVIDIA had also noted.
I do remember, Nez. I remember every single conversation we have had here on Opening Bid. Like, I just take all this home. Brooke, what are you looking at on Intel?
I mean, what we did see also was Evercore ISI upgrading the stock to outperform this morning. That's certainly adding to the momentum that we're seeing this morning, opening up 26% at the open. They admitted, though, here, they said Intel is already up 100% year to date. We might be a little bit behind on our timing. It's not optimal, but similar to what Inez was saying, is they think that this has more room to run. Right now, their price target is $111. They're only sitting at $84 right now. And I think that this is really a story. You know, Inez had mentioned about CPUs. They're calling this the CPU renaissance, saying that this is the fastest growing AI workloads need a lot more CPUs. And soon we'll see this flip, which not just Evercore, but other analysts on the street wrote, between CPUs and GPUs ratio turning around from 1 to 8 to 8 and 1. And so this could really be the beginning of momentum. And on top of that government stake that the government took in Intel, you also have these massive partnerships that the company has made an announcement over the last year with. That includes Google. That also includes Elon Musk's Terafab facility as well. So this is clearly gaining a stride here. And like Tom was saying too, if you're holding it now, it looks like Wall Street is optimistic. There's more room to run here.
Usually when we're talking, it's about something you're short. Now, Zoom is something that you guys decided to go long. So let's talk about Zoom. I'm first curious, how did you even come to this? Considering that you're usually looking for short ideas, were you looking at Zoom as a potential short, and then you said, well, actually, no, it's something that we want to be involved in?
That's right. So, I mean, we look at hundreds of companies, if not thousands, and this is one that's always been a battleground stock. So there's some people that think it's going to be displaced by, the SaaSpocalypse, or some people that think that it's a one-trick pony, that it's just consumer facing, but we think there's a misperception gap about what the company is, but more importantly, what it can be. And, we've laid out in our report 8 to 9 simple recommendations that we think can change that perception and, importantly, valuation gap to get the stock materially higher.
Yeah, so we don't have time to go through all of those, but, one of the things you talked about, and these are pretty straightforward recommendations. You're not talking about radically changing the business, right? But your first recommendation, for example, is improve capital allocation. So what do you think that they've done wrong that they should tweak in that area?
Right. So, they're overcapitalized. They have a pristine balance sheet. We're talking about $8 billion of cash, a multi-billion-dollar stake in Anthropic that's sort of a hidden asset on the balance sheet. And yet, the company's bought back a modest amount of stock. We think they could do upwards of $4 to $5 billion stock repurchase. We also think that they should issue a dividend. Why? Because let's face it, the company, the growth has matured. Now we think it's going to inflect higher, but we think they could support a $300 million a year dividend just with the current cash on the balance sheet. Now let's not forget this company is going to generate $1.7 to $2 billion a year in free cash flow, so they have to do something with it. And we think a dividend makes sense, and also a more aggressive stock repurchase.
One of the things you don't think they should use it for is M&A, or at least not M&A that is not good M&A. So, because you've looked at some of their acquisitions in the past, and you've said that maybe they weren't the best.
Yeah, well, they've done some very smart, tuck-in acquisitions to sort of augment their product offering. They try to do something more transformational that, fortunately, and for their benefit, failed. We don't think they should be more aggressive on the M&A front, but focus on improving operations. So, for example, one of our recommendations is streamline the organization. We've seen headlines of companies like Salesforce, Adobe, Microsoft, now Meta, Block, trimming their workforce to implement AI to improve operations. Zoom had a big hiring increase from COVID, and their workforce has been pretty stable. They have a somewhat bloated executive management profile. We think they have the opportunity to reduce costs on that front, and also put more capital towards marketing. As I said, there's a misperception that they're consumer-facing, but they have a big enterprise franchise, and they do more than just video. Contact center, workflow optimization. They really need to improve marketing, which we think will also help accelerate the top line.
Where is that top line growth going to come from?
Yeah, it's going to come from some of their higher growth products. So in their enterprise segment, which is growing faster than online, we think online's finally stabilized. But they did acquisition of WorkVivio. That we think is growing. They have a new revenue optimization product that's growing, and also the contact center business has been a high growth area. So we think that's going to continue, and we think if they accelerate on that a little bit and also trim some of the operating expenses and refocus more on marketing, that can drive the earnings per share, plus accelerating the buyback, shrinking the share count can also accelerate earnings per share.
Now, the very last recommendation you make is usually the thing that activists lead with, which is you should sell this thing. Now, the fact that you put it last is the idea that once they implement all this other stuff, then they should pursue a sale? Or is it that that's sort of a last resort if the other things don't work out?
I think so, yeah. I think there's some simple blocking and tackling that they can do. And one of them we said actually is they should push the S&P 500 committee to get in that index, create a whole new buyer base. I mean, we've successfully shorted many S&P 500 companies with lower margin profile, lower growth profile. This company deserves to be in the S&P 500 given its breadth, given its ability to execute, given its robust financial profile. So there's things that they can do, and if all else fails, we think this business could be attractive to not only strategic buyers, but also private equity buyers, and easily command a 35% premium to the current price.
One of the things you didn't suggest they do was change their leadership, which I thought was interesting.
Yeah. I mean, we think the CEO is phenomenal, right? I mean, he should be commended for leading this company through a rapid growth phase during COVID, but yet they've still continued to grow. And the margin profile's improved. The cash flow's been robust. Now, we do think that the executive team with 16 members could shrink a little bit. You look at other SaaS companies of their size, they operate a more leaner structure around 8 to 9. So we think there's some streamlining to do, but we don't think there needs to be radical change here. We just think they need to do basic blocking and tackling to accelerate the top line a little bit, streamline some of the costs, reduce the share count, and that should lead to a higher valuation.
You know what's been really interesting during this whole software sell-off is even the companies who seem to be doing fine are still getting punished. And so I wonder perception, because all of this is great, but if it doesn't change the perception, it doesn't matter, right? So how do you think they go about changing that perception that they are victim to what's going on in software?
Yeah, I think they have to tell that message. The CEO has to get out, come on Yahoo Finance, tell that story a little bit.
We haven't talked to Eric Guan in a long time.
Right. We think they need to do more of that, obviously. They're covered by some analysts that are telling the story, but I think ultimately it'll come out in the results. And what we're seeing with the results is their churn has been coming down, right, rather than accelerating. We've done some channel checks. We find no evidence that they're being displaced by the SaaS apocalypse.
See, it's really hard to say that word. I told you.
It is. And also, look at the short interest. It's actually been coming down a little bit.
Interesting.
Whereas if you look at the short interest from like a Salesforce or a ServiceNow or Adobe, it's actually rising. So we think that the market's coming around to our view that, hey, they're fairly well insulated. They have a great competitive moat, and there's value here. And we see that value, and that's why we're long the stock.
First, just explain to viewers what Learfield is all about, like the mission and the purpose, Cole. As I understand it, what you're all really doing sort of in simple terms is you're helping schools make money from their athletic programs. So like sponsorship deals, merchandise, NIL. Am I framing it correctly, Cole?
Josh, you're directionally right. Good to be with you. The simplest way to say it is that Learfield is the largest sports marketing, media, and technology company in all of college athletics. We, as you sort of described, we sit at the center of pretty much everything that happens commercially in college sports. We have the largest sports marketing or sponsorship sales organization in all of college athletics. We support over 150 schools in that part of our business. We oversee the largest ticketing technology company in college athletics, a company called Paculin. If you buy a ticket to college events, you're most likely buying that off of our back-end platform. platform. We provide all of the vast majority of official athletic sites, mobile apps through our business sidearm. We have the largest licensing agency in all of college sports. If you buy a product from Dick's Sporting Goods or from Kohl's or from Academy Sports and it's got a school's brand on it, it likely flows through our licensing agency. So again, with the exception of a few disciplines, pretty much anything that happens commercially in college athletics, we sit at the center of.
And how many schools, Cole, and brands do you all now work with?
Oh, wow. Well, it depends on the business unit. We're a conglomerate that has 5 operating business units. A few of them I just walked through. But the easiest way to look at it is there are 365 Division I schools, Jeff, in college athletics. And we work with every single one of those schools in some form or fashion. We have as many as 1,500 schools that we work with at Sidearm and 150 that we work with in our sponsorship business. And then on the sponsorship sales side of things, I would tell you we have more connectivity to brands across the country, and for that matter, across the globe, than any other sports entity. We have 12,000 brands that are in our portfolio, and that ranges from the smallest law firms or insurance agencies in college towns like Lubbock, Texas, and Tuscaloosa or Ames, Iowa, all the way up to multinational brands like Marriott and Dunkin' and Allstate. So we have a wide variety of brands in our portfolio, over 12,000 of them.
And how does Learfield make money, Cole? Like, walk me through the business model.
Well, again, sort of depends on the business, right? But for the most part, our job is to work with universities to maximize their revenue. And depending on that business line, there's a royalty that we take as well, or a rev share that we take from those operations. So when we sell a sponsorship, the preponderance of those dollars go to the universities, and we take a percentage of that as being the agent out there representing those schools at the national level and the local level. Similar for the licensing ecosystem with our business collegiate licensing Corp, CLC, as a product sells, and we help to sort of govern that ecosystem. We make a part of that sale. So it really just sort of depends. For the most part, it's about maximizing the revenue for the schools, and then we might take a small part of that.
And of course, the news now, Cole, TPG is buying Learfield. Why was this the right time, Cole, to sell a private equity? And I'm also curious, what does TPG sort of bring to the table, Cole, that was different?
I'll tell you, as I've gotten to know the TPG team over the last 6 to 8 months, better question is probably what do they not bring to the table? They're such terrific partners for the portfolio companies that they've had, and we're so excited to move forward with them, with their scale and their connectivity across the disciplines that I think matter to the future of this business: media, technology, and sports marketing. So for us, they've been just a terrific partner to consider along the way, and now we're thrilled to have them in the mix. In terms of why, why now? I think there's sort of 2 answers, Jeff, to point out. Number one of the things that's important to note is that Learfield has been owned by private equity firms for quite some period of time. There have been different iterations of private equity ownership over the past really 12 to 15 years. So in terms of our capital structure, this isn't necessarily novel. What is novel is having now a majority or controlling interest owner in TPG once we close, which from a strategic and operational perspective helps to make things a little bit more efficient in the boardroom when we're considering how we're going to deploy capital and the strategic directions that we're going to go in as a company, not just to continue powering the future of college athletics, but also as it relates to taking so many of these capabilities beyond our core business today. Having one capital partner in the mix, I think, really matters. Now, in terms of why now, and why that controlling interest and majority partner in TPG today, I think it's a matter of several things. First of all, the company is highly performant. We've had a phenomenal 3 to 5 years of growth in all areas, top line, bottom line, and free cash flow. Company's doing really well in a sector that doesn't really have a whole heck of a lot of companies that are at scale like Learfield. And the second reason is that we've seen in our sector of the industry, college sports, we've seen an unprecedented level of institutional investor demand over the last 12 to 24 months. Private equity firms wanting to find ways to invest in college athletics, be that an institution, a college, or a conference. And so our phone started to ring of interested parties wanting to find a place to not only invest capital, but of course, grow over the long term as well. And as it relates to college athletics, you probably can't find a better investment than Learfield, both in terms of the solidified position we have in the market and the industry today and the growth trajectory that the company's on.
When you think of college sports, Cole, I'm curious, just broadly, does it feel almost like, at this point, less like college, more like, minor league pro teams at this point?
You know, it really doesn't. I think that there's a bit of a misnomer over the last couple of years, ever since really NIL went into effect, which we forget this happened 5 years ago. The NCAA ruled on NIL being an opportunity for student athletes, name, image, and likeness being an opportunity for student athletes all the way back in July of 2021. So we're already 5 years into this new era. And I think the misnomer has been professional sports versus college sports, or professional sports versus amateur sports. And the reality is there's really only one thing fundamentally that has changed over the course of these 5 years, and that is student athletes can now earn revenue in primarily two places: directly from the institutions now, who can pay up to $20.5 million in revenue share, and they can earn revenue off of their name, image, and likeness in marketing deals that they do out in the market. Fundamentally, those are the only two things that have really changed across the college model. If you think about all the other fundamentals, I've used the term student athletes. There's a reason for that. They are students as they are participating on these courts and fields of competition. They are still attending class. There are still an average of 23 sports in Division I. Whether it's Fenway Sports or Kroenke Sports or any other large professional organization, you won't find an ownership group that has that many sports all under one umbrella. We're still a business driven by donors and boosters. So there's so much about our industry that is still very unique relative to professional sports that I still consider college athletics sort of the core amateur college sports that it always has been, the college sports framework and ecosystem that it has been, but it's certainly been evolving over the last 5 years, and it's going to continue to evolve in the years ahead.
Cole, so great to have you on the show today. Appreciate your time.
You bet.